Part 2. Commercial Banks and Other Financial Intermediaries. Now that you have a better understanding of what money is, let's discuss financial intermediaries, institutions that move money from those who want to save it to those who want to borrow it. Most financial intermediaries are depository institutions, normally called banks. Depository institutions are financial intermediaries that, by law, can accept deposits in transaction accounts and that together make up the banking sector. In a nutshell, depository institutions accept funds from depositors and loan these funds out to families and businesses. A bank loan is called a tool of indirect finance, as the bank intermediates between lenders, the depositors, and borrowers, loan applicants. The banking sector of the United States has three distinguishing characteristics: an unusually large number of small banks, a dual nature where some banks are chartered at the state level while others are nationally chartered. It's one of the most heavily regulated bank sectors in the world. The U.S. banking sector was greatly shaped by the nation's history. American historical wariness for centralized power led to the unusually large number of small banks that still operate in the country, as, up until 1927, banks could be chartered only at the state level. Starting in 1927, with the passage of the McFadden Act, banks could be chartered at the national level. However, the act subjected national banks to their home state branching rules, effectively prohibiting interstate branching and severely limiting interstate banking. The limits on interstate banking were later lifted by the Rigel-Neal Interstate Banking Act of 1994, which relaxed branching rules and started an era of bank mergers. The heavy regulatory environment typical of the U.S. banking sector is a consequence of the duality of the system, as well as an inheritance of the stock market crash of 1929 and the wave of bank panics and bank failures that followed in the 1930s. In response to the financial upheaval, Congress passed the Banking Act of 1933, often called the Glass-Steagall Act, which imposed limitations on the type of activities that banks could engage in and on the interest rates they could pay on deposit accounts. Also, since the banking sector is dual, most banks are regulated both at the state and at the national level, and they are subject to supervision from state and federal agencies. Starting in the 1980s, the U.S. banking sector witnessed a process of deregulation. In 1980, the Depository Institutions Deregulation and Monetary Control Act, DIDMCA, allowed banks to pay interest on special demand deposits called NOW accounts. Starting from the mid-1990s, the reinterpretation and then complete repeal of the Glass-Steagall Act, Gramm-Leach-Bliley Act of 1999, allowed banks to engage in a wide array of non-bank financial activities. Commercial banks are the largest category of financial intermediaries by value of assets. In the United States, commercial banks can be chartered and supervised by states, state banks, or by the Office of the Comptroller of the Currency, OCC, a branch of the Federal Treasury, national banks. All national banks and some state banks are members of the Federal Reserve System. Most commercial banks have assets between $100 million and $500 million. However, the largest commercial banks have assets of more than $10 billion each, which means the largest 1% of banks holds more than 70% of all banking assets. Commercial banks are stock-owned and earn profit by accepting deposits, extending loans, investing in securities, and offering various financial services for a fee. Deposits at commercial banks are insured by the Federal Deposit Insurance Corporation, FDIC, for up to $250,000 per account. More than 1,000 U.S. banks are saving associations, SAs, and savings and loans associations, S&Ls. These primarily extend residential loans. They started as mutual institutions that collected members' funds through savings, thrift deposits, and financed residential developments for their members. Nowadays, many such associations are stock-owned, accept demand deposits, and extend a wider variety of loans. SAs and S&Ls can be chartered at the state or national level and are regulated by the Office of Thrift Supervision, OTS, which is now merged with the OCC. Deposits at SAs and S&Ls are insured by the FDIC. In the 1980s, a spike in interest rates led to a severe crisis of the S&L system, which was then overhauled. Nowadays, thanks to a number of regulatory changes, S&Ls perform many of the same activities as commercial banks. Credit unions are mutual institutions where members with a common bond deposit savings shares and apply for consumer loans. Because of the common bond, these institutions are quite small and, like other types of clubs, benefit from tax advantages and are not subject to antitrust regulation. They can be chartered by states or at the national level. The National Credit Union Administration regulates and oversees federally chartered credit unions, and the National Credit Union Share Insurance Fund, NCUSIF, insures deposits at all credit unions for up to $250,000 per account. In times of crisis, credit unions can borrow funds from the Central Liquidity Facility, CLF. Banks are just one type of financial intermediary. Several other types of firms offer different services of financial intermediation. With the deregulation of the banking sector, today's bank holding companies are often made up of various financial intermediaries. The other most important types of financial companies are investment banks. Investment banks help companies issue securities like stocks and bonds to raise funds directly from the public, unlike commercial banks that offer borrowers indirect finance. They also assist companies with mergers and acquisitions and risk management. Insurance companies. Insurance companies are financial intermediaries that help people better manage the risks in their lives and protect themselves from financial losses. Typically, insurance companies offer contracts in which, for the payment of a fixed premium, they promise to reimburse certain expenses, such as medical expenses or car repairs after an accident. Mutual funds or pensions funds. Mutual funds are professionally managed pools of funds invested in various securities like stocks and bonds. The fund's owners are called shareholders. Funds that are used to pay pensions are called pension funds. Bank Holding Company, BHC. These are financial companies that own one or more banks. In the past couple of decades, the importance of these financial intermediaries has significantly grown. They often lend funds just like commercial banks would do. However, instead of doing so by extending loans, they channel funds through the various securities markets. Often, these institutions are referred to as the shadow banking system. Commercial banks and other financial intermediaries are for-profit enterprises. Banks earn profit by charging fees, credit card fees, for example, and by borrowing funds at a low interest rate and lending those funds at a higher interest rate. Economists call this activity asset transformation. Here is an example of asset transformation. When an individual deposits $1,000 in a checkable account at First Bank, the deposit increases First Bank's reserves by $1,000. By law, the bank must keep a share of that deposit as required reserves. In the United States, the required reserve ratio varies depending on the size of the bank, with higher ratios imposed on larger banks. However, the bank can loan out up to the full amount of its excess reserves. Suppose the required reserve ratio is 10%. After a deposit of $1,000, First Bank can loan out up to $1,000 minus 10% times $1,000, which equals $900. If First Bank pays an interest rate of 0.5% on its checkable deposit and charges an interest rate of 5% on its loans, at the end of the year, the bank has 5% times $900 minus 0.5% times $1,000, which equals $45 minus $5, or $40 of income it can use to pay for non-financial expenses and to distribute a dividend to its stockholders. To fully understand the different activities performed by financial intermediaries, it is important to understand how these organizations raise funds and use them. We can do so in an organized way by taking a quick look at the typical balance sheet of a commercial bank. The balance sheet is an accounting tool with two columns, one listing a firm's liabilities, money owed, and capital, net worth, and the other listing the firm's assets. At all times, the two sides balance. Assets equal liabilities plus capital. A bank's liabilities and capital show how the bank raises money, while the bank's assets show how the bank uses that money. Liabilities are funds the bank owes to some person or business. The larger share of a commercial bank's liabilities is in the form of deposits. These come in three types. 1. Demand deposits. Deposits that can be withdrawn without limits, like checkable accounts, 18% of all deposits. Until 2011, they were not allowed to pay interest in accordance with Regulation Q, the regulation that, in accordance with the Banking Act of 1933, Glass-Steagall Act, prohibited paying interest on deposits payable on demand. Negotiable orders of withdrawal, NOW accounts. Introduced by the Depository Institutions Deregulation and Monetary Control Act, DID-MCA, in 1980, these are deposits that, while structured similarly to checking accounts, were not considered demand deposits and hence were allowed to pay interest in compliance with Regulation Q. 2. Savings deposits, 61% of all deposits. There are two main types of saving deposits. Savings accounts, accounts that pay interest but that do not allow writing checks, 20%. Money market deposit accounts. Similar to money market mutual funds shares, however, they are federally insured and pay interest. The law limits transfers to third parties to 6 per month, 47%. 3. Time deposits, 15% of all deposits. The funds in time deposits are available only at a specified time in the future, maturity date. The two most important types of time deposits are certificates of deposit, CDs, certificates issued in specific amounts that pay a fixed interest rate, negotiable certificates of deposit. These have larger denominations than regular CDs, $100,000 or more, and are negotiable. Other important liabilities on a commercial bank's balance sheets include borrowed funds. Funds borrowed from wholesale money markets. Their importance increased as demand for loans outpaced banks' ability to attract new deposits. Federal funds. Funds held at the Federal Reserve as required or excess reserves. Repurchase agreements, repos. A form of loan where the bank sells a security to a lender with the promise to repurchase the same security for a specified price at a specified date. Eurodollars. These are deposits denominated in dollars but held in foreign branches of U.S. banks, or at foreign banks. The interest rate banks charge each other in the Eurodollar market is called the London Interbank Offer Rate, LIBOR. Fed loans. These are funds the bank has borrowed from the discount window of the Federal Reserve. The term is typically 15 days. Trading liabilities. Funds owed due to losses on derivative contracts or due to short positions, when the bank sells securities it does not own. A bank's equity capital is also called net worth. Banks have lower capital than most other firms. The smaller the ratio of a bank's capital to its assets, the more leveraged the bank is. There are two types of bank capital. 1. Capital stock. The funds stockholders have directly invested in the bank. 2. Undivided profits. Profit that has not yet been paid out as dividend. Under assets, we find the different uses of the deposited or borrowed funds. The majority of assets comes from money that others owe to the bank. Here are some of the main examples of assets. Cash assets. Very liquid assets the bank holds as cash in vault or funds deposited at the Federal Reserve Bank. Fed funds sold and reverse repos. The reverse of a repurchase. In this case, the bank is lending funds by purchasing securities from the borrower, who agrees to repurchase them at a future date for a specified price. Investments. highly liquid portfolios of bonds issued by the U.S. government or a U.S. government agency or a municipality. They can be easily sold when the bank is in need of reserves, and they give tax benefits. Bonds are standardized contracts that provide the issuer financing, but no other service. Loans. More than 55% of commercial banks' assets are represented by loans. Loans are not as liquid as investment assets and are contracts specifically designed to address each customer's needs. Most bank loans are secured with some form of collateral. If the lender defaults on the loan, the bank acquires ownership of the collateral. A mortgage, for example, is a secured or collateralized loan. Some loans charge a fixed interest rate, while others charge a floating interest rate that moves following a benchmark rate, like the LIBOR or the prime rate. Banks extend commercial loans to businesses, real estate loans, mortgages to individuals, and businesses for the purchase or remodeling of buildings and structures, agricultural loans to farmers, and consumer loans to individuals. Bank credit cards are a growing type of consumer loan. The first credit cards offered only local credit, but starting in 1966 with changes in bank regulations, they have become a national phenomenon. A cardholder has access to funds up to a set limit, and each billing cycle must pay a minimum installment. Interest is charged on any purchase not covered within the monthly billing cycle. Leases. Starting in the mid-60s, banks could purchase items that they leased to individuals or businesses. This type of contract has tax advantages. When a bank has to meet an unusually high volume of withdrawals, it can generate the necessary reserves in several ways. The bank could borrow funds in the federal funds market, sell some liquid securities, borrow funds from the Federal Reserve through the discount window, or reduce the stock of loans, either by not renewing some of the short-term loans that reach maturity that day, that is, by calling in loans, or by selling some loans to other financial intermediaries. Each of these actions comes at a different opportunity cost. For example, the bank has to pay the federal funds rate on funds borrowed in the federal funds market and the discount rate on funds borrowed from the Federal Reserve. Calling in loans can spoil the relationship with a valuable client. The bank manager has to decide which option is the most profitable and, at the end of the day, might decide that the bank should hold a large volume of excess reserves instead. Bank managers purchase and sell assets and liabilities to reach 3 goals: earn the highest returns, avoid risk, and guarantee liquidity. There are 4 strategies bank managers can follow to reach their goals. They can seek borrowers who are willing to pay high interest even if they have a limited risk of default. They can buy securities that pay high returns even if their risk is low. They can diversify the bank portfolio, and they can hold some very liquid securities even if these pay low interest. After the 1960s, checkable deposits ceased to be the main source of funds at commercial banks. Now, when a commercial bank wants to raise funds, it can sell a negotiable CD or borrow funds in the federal funds market. Banks can increase their profit by paying attention to the composition of their liabilities. Banks face a trade-off when choosing an adequate level of bank capital. On the one hand, banks must keep a minimum amount of capital to avoid failure and to meet regulatory requirements. On the other hand, the capital stock affects the rate of return the bank can pay to its investors. Economists use 2 measures to assess a bank's profitability: the return on average assets and the return on average equity. For a given return on assets, the lower the capital stock, the higher the return on average equity. Banks face 2 sources of risk that could rock their operations and push them in the red: credit risk and interest rate risk. Credit risk refers to the possibility that borrowers default on their loans, while interest rate risk refers to the possibility of sudden changes in the interest rate the bank charges its debtors or pays to its creditors. Information asymmetries on borrowers' creditworthiness lead to a problem called adverse selection, where charging higher interest rates attracts riskier borrowers, in effect selecting an adverse outcome for the bank. Information asymmetries on borrowers' choices and actions lead to a problem called moral hazard, in which, since banks cannot monitor borrowers' use of funds, borrowers have an incentive to take up more risk than they can handle, consequently raising the hazard of default. There are several strategies bank managers can follow to reduce moral hazard and adverse selection. They can collect detailed information on loan applicants, screening out borrowers with higher chances of default. They can visit commercial borrowers to monitor how they are employing the borrowed funds. They can specialize in specific types of loans or in specific geographical areas to gain higher expertise and reduce the cost of screening and monitoring. The tool banks most commonly use to reduce moral hazard is collateral requirements. Collateral is any asset that by contract the bank acquires in case of default. Vehicles, real estate, or financial assets are often used as collateral. Compensating balances, funds the borrower must keep deposited at the lending bank for the duration of the loan, are another form of collateral. To limit moral hazard, banks develop long-term bank relationships with their clients, who then find it more costly to choose projects that raise their risk of default on a loan. Long-term relationships also lower the cost of screening and monitoring future loan applications from the same client. Interest rate volatility raises a bank's earnings volatility, exposing the bank to undesired risk. There are two approaches economists use to analyze interest rate risk: gap analysis, which focuses on the difference between interest rate sensitive liabilities and interest rate sensitive assets, and duration analysis, which evaluates how changes in interest rates affect the value of assets and liabilities in the bank's balance sheet. The name of this approach comes from the relationship between a security's market value, the interest rate, and the number of years during which the security will produce a stream of payments, called the security's duration. Over the last 2 decades, as banks have become more reliant on fee-based activities instead of interest-based activities, a larger share of banks' activities are not reflected in changes of the balance sheet. These are the so-called off-balance sheet activities. Banks charge fees on a variety of financial services, from foreign exchange trades to the creation of structured investment vehicles and securitization. More traditional off-balance sheet activities, however, are loan commitments or promises to lend money according to agreed rules. Credit card limits, lines of credit, and revolving credit are 3 kinds of loan commitments. Banks are also more likely to engage in loan sales and loan brokerage. If they have specific expertise in a geographic area or a type of client, banks earn profit by cheaply originating loans they resell at a higher price to other financial intermediaries. The practice has become so widespread that the loan-related data in call reports are becoming less and less informative of the overall volume of loan origination. Governments that wish to mitigate adverse selection and moral hazard in credit markets heavily regulate the banking sector to protect consumers from abuses and to enhance the stability of the financial system. As we mentioned earlier, in the United States, several agencies charter, regulate, and supervise commercial banks and other depository institutions, and it is possible for the same financial institution to be regulated and supervised by up to 4 different state or federal agencies. Banking regulation and supervision is very complex. Here we will break it down into its most relevant categories. Capital requirements are regulations that force banks to keep a sound amount of capital. Banks with more capital are less likely to fail. Equity capital is an effective buffer when a bank must absorb losses. Also, more capital means the bank has more to lose from poor management and risky activities, significantly reducing problems of moral hazard. Until the mid-1980s, capital requirements were set in terms of the leverage ratio, the ratio between core capital and total assets. In 1988, however, the central bankers of the United States and 11 other high-income countries signed an accord known as Basel I that introduced the idea of tying capital requirements to a bank's risk exposure. In the United States, current regulation now divides capital into 2 categories, called Tier 1 capital, or core capital, and Tier 2 capital, or supplemental capital, and requires a bank's leverage ratio to be higher than 3% and that the ratio of Tier 1 plus Tier 2 capital to risk-weighted assets be at least 8%. When computing risk-weighted assets, Assets are divided into 4 categories, from less risky to more risky, and assigned different weights. Off-balance sheet activities are also factored in after they are converted into on-balance sheet equivalents and assigned to the different risk categories. To protect the public from scams, banks are chartered after a long review process. Charter applicants must provide extensive information on the bank's business plan, suggested senior management, and financial viability. Once operating, banks must file quarterly call reports describing the bank's operations and financial conditions. Banks are also subject to periodic unannounced safety and soundness examinations. Bank examiners review the bank's records for possible fraud, analyze assets, loans in particular, and liabilities to assess the bank's creditworthiness and verify management's ability to identify and monitor risk. Regulators use information from the call reports and the on-site examinations to rate each bank on a scale from 1, highest, to 5, lowest, according to the CAMELS rating system, which stands for capital, asset quality, management, earnings, liquidity, and sensitivity to market risk. Starting in the mid-90s, regulators raised their emphasis on supervising banks' risk management, and large banks must pass stress tests, simulations that assess how the bank would weather severe economic shocks and whether the bank needs to raise more capital. To alleviate problems of asymmetric information, regulators require banks to disclose information on the composition of their assets and risk exposure. Disclosure requirements allow investors, stockholders, and depositors to gain all the information they need about the financial condition of a bank to make good decisions. Indirectly, this nudges bank managers to steer away from excessively risky activities. Disclosure requirements were first introduced in the 1930s and were greatly tightened by the Sarbanes-Oxley Act of 2002. Another goal of bank regulation and supervision is to protect consumers from scams, discrimination, and predatory lending practices. Starting in 1969, the Truth in Lending Act, Consumer Credit Protection Act, CCPA, requires that lenders, including banks, give borrowers clear and correct information on the interest rate they pay. For each loan, creditors must clearly indicate the annual percentage rate, APR, and total finance charges. The Fair Credit Billing Act, FCBA, requires that credit card issuers clearly state how they will assess finance charges and that they resolve billing disputes quickly. The Fair and Accurate Credit Transaction, FACT, Act regulates credit reporting agencies, protecting them from state-level overregulation and requiring that each year consumers are entitled to a free credit report. The Equal Credit Opportunity Act, ECOA, forbids banks from discriminating according to race, age, gender, marital status, and national origin, while the Community Reinvestment Act, CRA, of 1977 requires that banks offer credit to individuals and firms from all neighborhoods in their market area and refrain from redlining, the practice of using a red marker to highlight on a map neighborhoods where the bank does not extend loans. Compliance with the CRA regulation is heavy in documentation and costly. What's worse, by requiring banks to offer loans in all areas, including economically depressed neighborhoods, the CRA has the unintended consequence of leading banks to extend risky loans to financially weak families that are unable to repay and end up bankrupt. As we mentioned earlier, when a bank can no longer meet its obligations to depositors and creditors, it fails. A bank failure can be triggered by illiquidity or insolvency. During a bank crisis, depositors withdraw their funds all at once, and even a sound bank can find itself illiquid and unable to meet its obligations. In such a time, even sound banks are forced to sell security investments at a loss, losing assets and risking bankruptcy. Central banks prevent this type of failure by acting as lenders of last resort. Since 1914, the Federal Reserve offers liquidity to distressed member banks through its discount window or through open market operations, acting as a lender of last resort to these intermediaries. Excessive risk-taking lies behind failures triggered by insolvency. As we mentioned before, bank managers tend to extend loans and buy securities that are risky, as these pay higher interest. However, if creditors default on their loans and security prices drop, the bank can suddenly lose assets and, unless it has an adequate amount of equity capital, it quickly finds itself unable to repay short-term debt or meet depositors' cash withdrawals. Capital requirements help prevent failures due to insolvency. Before new regulation was introduced in the 1930s, bank failures would spread like a contagious disease. One single bank failure would make all depositors nervous. Because of asymmetric information, depositors could not tell if their bank was sound or on the brink of collapse, and they would all rush to withdraw their funds at the same time, triggering bank runs and bank panics. Economists call this phenomenon the financial contagion effect. From the late 1800s through the 1930s, bank failures were a serious problem, and bank panics were frequent. Between 1920 and 1933, more than 10,000 banks failed. By statute, only member banks could borrow from the Federal Reserve as a lender of last resort, and fewer than 10% of depository institutions were members. The number of bank failures, however, dropped precipitously after the establishment of the Federal Deposit Insurance Corporation, FDIC, by the Glass-Steagall Act in 1933. The FDIC insures deposit accounts and prevents bank runs and panics very effectively. Today, the FDIC insures depositors at commercial banks and S&L associations for up to $250,000 per account. The National Credit Union Share Insurance Fund insures accounts at credit unions. While all types of deposit accounts, checking accounts, saving accounts, money market accounts, and certificates of deposit are insured, the FDIC does not cover other financial products like investment accounts, shares in mutual funds, or life insurance. Let's discuss how the FDIC handles failed banks. Typically, insolvent banks are shut down by their chartering authority. In rare cases, however, after a negative examination, the FDIC makes the decision to resolve a failing bank. Once the decision to shut down a bank has been made, there are two methods the FDIC can use to resolve the failed business: the payoff and liquidate method, and the purchase and assumption method. By law, the FDIC must use the method with lowest cost. Under the payoff and liquidate method, the FDIC pays off depositors up to $250,000 per account, and then liquidates all the bank's assets to pay off all other debts. Creditors have different levels of precedence. Depositors and the FDIC are paid off first, then general creditors, and last, if any money is left, it pays shareholders. Under the purchase and assumption method, the FDIC brokers the sale or merger of the failing bank with a willing and financially stable institution. The FDIC often facilitates the deal by extending subsidized loans or by assuming some of the bad loans and investments of the failing bank. Under a clean bank purchase and assumption, the assuming bank keeps only the failing bank's insured deposits and purchases only few of the bank's assets. On the other hand, under a whole bank agreement, the assuming bank receives all assets and liabilities for a one-time payment. Deposit insurance reduces the risk of financial contagion and the likelihood of bank panics. However, it creates several types of moral hazard. Deposit insurance reduces depositors' need to monitor their banks, worsening market discipline. Because insured depositors do not bear any of the bank's risk, managers are able to attract depositors at low interest even while extending risky loans. Even if these loans fail, the bank can still look profitable by propping up earnings with origination fees, since it can still attract cheap deposits to raise loanable funds. The FDIC has always shied away from liquidating large failing banks, creating an incentive for shareholders, uninsured depositors, and creditors to own or do business with large banks instead of smaller banks. In 1984, when one of the largest American banks called Continental Illinois almost failed, the FDIC went a step further and announced that a number of very large American banks were too big to fail, or TBTF, and would never be liquidated. The policy wanted to prevent instability in the banking sector. One bank's liability is another bank's asset, and the liquidation of one very large bank could drastically reduce the value of other banks' assets, triggering bank runs and bank panic. However, the too big to fail policy exasperates the problems of moral hazard we mentioned earlier, and it gives large banks an unfair advantage in attracting depositors at low interest rates, as all deposits at TBTF banks are effectively insured. However, in September 2008, the failure of Lehman Brothers, an investment bank, had dramatic consequences on the financial system, highlighting that indeed some financial institutions are too big to fail and heightening regulators' emphasis on what economists call systemic risk, events that would rock the whole banking and financial system instead of just one financial intermediary. This is the end of Part 2, Commercial Banks and Other Financial Intermediaries. In the next video, we'll cover central banking and the Federal Reserve.